If you're about to retire, you've probably heard all three of these things. Just use the 4% rule, you'll be fine. No, the bucket strategy is the best way to avoid selling in a crash, or actually, guardrails are the best way to get more income. But here's the problem, they can't all be right for you. In the next few minutes, I'm going to show you how each strategy really works, tell you the hidden risks that almost no one mentions, give you a simple way to pick the one that aligns with your personality and goals, and give you a sneak peek into our philosophy at Legacy Ascent Wealth. And I'll do it using a real example in a $1 million portfolio and a couple retiring this year. I'm Dustin Rudolph at Legacy Ascent Wealth, and welcome to this episode of Summit Ascent Retirement. You've spent decades climbing the mountain to retirement. This video is about the descent, how you actually spend the money without running out. Let's jump into three strategies and I'll show you a side-by-side comparison at the end. Here's how it works. First up is the 4% rule. This was developed and published by William Banger in the 1990s, and he wanted an easy, simple way that his clients could follow with their money to last throughout the retirement. Let's say you retire with $1 million. In year one, you withdraw 4%, or $40,000. Every year after that, you increase that dollar amount by inflation, no matter what the market does. It's pretty simple, and that's why it's so popular. What people love about the 4% rule is it's easy to understand. You can plan a steady paycheck in retirement. Historically, in many scenarios, it's had a very high success rate over a 30-year time frame. But here are problems that I see all the time with actual clients. One is it doesn't adapt to reality. If you retire in a bad market and just keep spending the same inflation-adjusted amount, you will put incredible stress on your portfolio early on, and it can be very difficult for your portfolio to recover on those losses. The next problem, you die with way too much money. In many historical periods, 4% was actually way too conservative. People end up underspending for decades because they're following a rule that never changes, even when markets do well. Now, a lot of people want to leave money to their heirs, whether it's their children, grandchildren, charities, whatever it may be. However, you can still do that with living your best retirement. The next problem is it was designed for a 30-year period, and now people are living longer and longer. So in order for the math to continue to work out in this conservative approach, you need to reduce that by 50 basis points on average to a 3.5% withdrawal rate. Now this is incredibly conservative and runs into the problem that we just talked about. So who is the 4% rule best for? Someone who wants simplicity, someone who hates tinkering, would rather be conservative and leave more behind than they planned. If you want to set it and forget it strategy, the 4% rule checks that box, but there are trade-offs. Next up, the bucket strategy, probably the most popular for nervous investors. You have three different buckets, now, soon, or later. The now bucket includes 1 to 3 years of spending in cash or very safe investments. All investments include risk if you're investing in the market. The next bucket, soon. The next 5 to 10 years in bonds or conservative type of funds. And later, long-term growth money in stocks. You spend from bucket one first. In good markets, you refill bucket one from the growth market. In bad markets, you let the growth bucket recover while you keep spending from cash. So why does this strategy feel so good for many retirees? One, you know your near-term spending is predictable and it feels safe. When the market drops, you're not forced to sell stocks at the worst time, and psychologically, it's easier to stay invested in stocks when you see my next few years are covered. But here's the catch that almost never gets talked about. To feel safe, many people leave too much money in cash in very conservative investments. This is what I call the cash drag. A big chunk of your money is earning very little. Over 20 to 30 years, that can mean tens to hundreds or thousands of dollars in lost growth, which ironically makes running out of money more likely in your 80s and 90s. So who's the bucket strategy best for? Someone who is sensitive to market swings, someone who checks their account often and needs to see this year's paycheck is safe to sleep at night. It trades a bit of long-term potential for short-term peace of mind. For some people, that's absolutely worth it. Third is the guardrail strategy, sometimes called the dynamic or Guyton-Klingler approach. Think of it as the 4% rule with a feedback system. Here's the basic vision. You start with a withdrawal rate, let's say maybe 5% instead of 4%. So on $1 million, you get $50,000 per year. Each year, we check on that portfolio. If the portfolio is done really well and grows beyond a certain point, you get a raise. If the portfolio has dropped and crosses a lower guardrail, then you take a pay cut until things recover. In other words, you're adjusting your spending to what the market is giving you. The big advantage is you can start with more income than the 4% rule. You reduce the risk of running out of money because if markets are bad, your spending automatically tightens. If the markets are strong, you actually get to enjoy more of your money while you're still healthy. The catch to this strategy isn't math, it's the psychology. Can you handle a 10 to 20% pay cut in retirement if the market has a bad run? Are you willing to be flexible with your lifestyle from year to year? Some people are totally fine with that. Others find it completely stressful. So who is Guardrails best for? Someone who wants to maximize what they're able to spend. Someone who can emotionally handle some ups and downs in their retirement paycheck. It's for the flexible retiree who says, if things get tough, I can tighten the belt a bit. So let's put all of this together so we can see which ones align with you the best. Imagine 3 different sliders: simplicity, psychological comfort, and maximum income. The 4% rule is the most simple out of all of these approaches. Psychologically, it might feel comfortable. However, you are very exposed to sequence of returns risk and you can get yourself into trouble. And it's towards the bottom on maximum income because in most market scenarios, you're significantly underspending. And at Legacy Ascent Wealth, we say where you can spend to where you are spending, that is regret. That's missed out experiences and memories that you could be creating. So let's look at the bucket strategy. It's moderate in simplicity because there are a few different moving parts that we need to keep track of. It is the most comfortable out of all these approaches because you know that you don't have to touch your investments if the market's going on a bad run. However, it's not the most efficient way to take income because of the cash drag that it creates on the overall portfolio. Guardrails are the least simple because it's a lever going up and down on a year-to-year basis. It can feel somewhat uncomfortable because you may need to take a pay cut in the near future. However, it's at the top of taking the maximum amount of income because you are being flexible in being able to have the highest withdrawal rate of any of these strategies. So ask yourself, if I need simplicity above all else, the 4% rule is probably your starting point. Do I value peace of mind in down markets above growth? A bucket strategy may be the best place to start. Or do I safely want to spend as much as I can, and am I okay with some flexibility? A Guardrails approach is worth a serious look. But at Legacy Ascent Wealth, we approach this a little bit differently. We don't start with withdrawal percentages, we start with structure. Every client plan includes 3 pillars. Number 1 is the income base, where we know how we're going to cover essential expenses, which includes Social Security, a pension if you have one, other predictable income, and any coordinated portfolio withdrawals. The income base addresses longevity risk and market volatility risk. It ensures your housing, food, insurance, and baseline living costs are covered. When your foundation is secured, everything else becomes easier. However, we're not limiting how we're putting our money aside in just cash. We're earning above and beyond that. But as opposed to the bucket approach, we're looking for how do we increase our predictable income. Next, we're looking at liquidity. This is your cash reserves, flexible funds. Why? Because you want to go on that European vacation, or maybe a health event comes up. You have home repairs, or there's an opportunity that you can't wait to jump on. Liquidity addresses emergency risk and prevents you from disrupting your long-term investments. And lastly, growth. Once income base and liquidity are established, growth can be positioned intelligently, not recklessly, not overly conservative, but aligned with your risk tolerance, your legacy goals, and your inflation needs. Growth addresses inflation risk and increases your lifetime spending flexibility. So when you look at it, this is really a combination of the bucket approach and the guardrails. Because when your income base, liquidity, and growth are properly aligned, you don't overhoard cash in buckets. You can apply guardrails to the growth portion, increasing withdrawals responsibly when markets cooperate. And that's how you account for living longer than expected, market crashes, rising costs, health events, not by picking a formula, but by building a structure. Here's the takeaway. There's not a perfect plan for everyone, but there can be a perfect plan for you. And the best one is one that you can understand, stick with, and sleep well at night following. Most of the plans that I build for clients actually blend elements of all three of these. Do you have an income base? Do you have liquidity? Is your growth positioned efficiently? If those three pillars are aligned, the withdrawal strategy becomes far more resilient. If you'd like help structuring that for your own situation, there's a link below to schedule a conversation. And if you want to go deeper into withdrawal order and taxes, which is where many retirees accidentally lose tens of thousands of dollars, I've linked that video here. I'm Dustin Rudolph with Summit Ascent Retirement. Subscribe for more retirement planning that's structured, clear, and designed for real life, not just spreadsheets. Until next time, we'll see ya.